Welcome back, everyone. Today we're going to be evaluating Oracle stock. We're going to do an analysis on their numbers and then run a DCF model to get a fair value on the company. Okay, so let's go ahead and jump right in and look at the company's growth over the last 5 years. So if we look at the revenue growth over the last 5 years, it grew from about 37.7 billion to 40.4 billion. So you'll take notice that they don't really appear to be a fast-growing company. This just appears to be a company to me that has really hit its mature stage and does not see a lot of growth anymore. And this is also supported by the fact that if you go back to 2012, about 10 years ago, their revenue was about 37 billion then. So they have not seen a lot of growth in the last 5 years, but they haven't even seen a lot of growth in the last 10 years. Next, we'll look at their net income growth to about 9.4 billion in 2017. To 13.7 billion in 2021. Now, I'm sure you may have noticed in the year 2018, the net income was substantially lower than all the other years. Now, let's remember net income is revenue minus your expenses. And that includes stuff like operating expenses, overhead cost, taxes they have to pay, interest on debt. However, when I took a look at their financial statement, I noticed that it was none of those things. It wasn't their normal operating expenses or normal expenses that they would have. Rather, that big loss of a little over 6 billion from the net income was labeled under something called extraordinary items. So the basic rundown on extraordinary items is it's an infrequent or unusual event that happens. So it's not something that normally happens and does not define their underlying principles, how they're actually doing as a business. I don't know what this extraordinary item was for Oracle in the year 2018, but a ridiculous example of one would be this. Let's say that you own a farm and like half of your crops are wiped out, destroyed by something like a natural disaster like an earthquake or a hurricane. That's something you could label under an extraordinary item. So moving on, we have free cash flow growth from 2017 to 2021, going from about 12.1 billion to 13.7 billion. Next, we look at Oracle's debt. Now, I like to look at the average last 5 years of free cash flow, which in this case was about 12.8 billion, and multiply it by 3. That gives us about 38.3 billion. Then we compare it to their long-term liabilities, which we want to be under that amount. Now, in this case, it was not. In fact, the long-term liabilities are 73.4 billion, and that is literally almost twice as much. So definitely not a check right there. We do, however, look at their current ratio, which is current assets divided by current liabilities, and basically is defined as if a company were to liquidate today, would their current assets cover the current liabilities? Current assets are about 55.5 billion, current liabilities 24.1 billion. I typically like to see this number closer to 2. Well, it's 2.3, so that's definitely a check. Okay, now we get to the DCF model and we need to come up with a revenue growth rate over the next 5 years that we want to apply. Coming to a revenue growth rate on this company was kind of a little difficult, and I'll explain why. So your average analyst over the next 2 years is looking at an average of 4.6% over the next 2 years. What made this so hard for me is that's pretty good growth considering the growth they've had over the last 5 years and last 10 years. To put that into perspective, over the last 5 years, I ran a compound annual growth rate, and it was only 1.3% on average over the last 5 years. But even worse was their last 10 years. Remember, 2012 was about 37 billion, and 2021 was about 40.4 billion, so the compound annual growth rate for that over the last 10 years was a measly 0.87%. That's not even a percent. That's less than a percent. Now, I don't know Oracle and their business model too well. I know they're kind of in the information technology sector, kind of the cloud sector too. It's like they're a technology company, which you'd think would be doing very well because tech companies do. But this is a company over the past 10 years that has had very stagnated growth. I will note, however, that over the last year, between 2020 to 2021, they saw 3.6%, which is much higher than their average for the last 5 and 10 years. When I do these models, I don't like throwing a company a bone. But in this case, the growth was 3.6% over the last year, and your average analyst just absolutely thinks this is going to be over 4% growth for the next 2 years on average. I don't know what I'm missing here. Perhaps the company hit an inflection point. If you don't know what that means, it's basically kind of like this, where a company's kind of just been stagnating and then they hit an inflection point and that curve starts to go up. I'm not a huge fan of believing in that, but I do know that the concept is very real and can apply to companies. So after all that, I decided on 3% for a revenue growth rate. So if we head to the model, we grow the revenue out by 3%, and the year 2026 comes close to $47 billion. Then I came up with a free cash flow margin. Remember, that's free cash flow divided by revenue, and I did that over the last 5 years, and your average free cash flow margin was 32.54%. That's a really good free cash flow margin, and all of the years for the last 5 years were above 30, except for 2020, which was 29.6. Considering the average is 32.54, I thought it was fair to make the free cash flow margin 30%. We apply that to all of the projected years. We also had to come up with a terminal value for the company based on last year projected free cash flow. And you do get that number by applying your weighted average cost of capital, which I use 7%, and a perpetual growth rate, which I normally like to use 2.5%. However, just because I feel that this is a very matured company, I went with 2% this time. Now we have to apply our discount rate, or the rate of return we want, which I use 12%, add up all the values, divide by shares outstanding, and we get an intrinsic value of about 78.85%, or we'll roughly call it a fair value of $79. So there you have it. Based on the model, it comes out to about a fair value of $79. The current share price is about $76. So technically, this is a buy according to the model. Although it's only a buy by a little bit, literally a little bit, it's basically already at fair value. There's not a whole lot of upside potential according to the model. And me personally, this isn't a stock I'm buying right now. Again, according to this model, it's really basically at fair value already. And that's according to this model. I still did not feel very good about giving this a 3% revenue growth rate just based on their growth over the last 5 and even 10 years. I don't know enough about the company. Maybe something has sparked some growth again in them, but it's not something I feel super confident about. And already there's not really any upside potential here. Okay, so let me know what you think about Oracle down below. Do you think it's a buy, a hold, a sell? And if you're watching and you know a little more about Oracle as a company and a stock, let me know down below. Is there something that I'm missing when it comes to their growth? Has something sparked again that's giving them better revenue growth? And if you did enjoy the video, go ahead and sub to the channel if you're not already, and give the video a thumbs up. Okay everyone, we're gonna wrap this one up. So with that, you guys have a great day.